Greece is about as close as it's been to the edge of the economic precipice. Yesterday, a new reform package from the governing Syriza party to European and IMF creditors promised a higher budget surplus target and an increased value-added tax rate, two previous no-nos. But the Europeans seem to be taking a tougher stand now. German Chancellor Angela Merkel and French President François Hollande are set to meet with Alexis Tsipras in Brussels later today. So what next? Well, Ken Courtis is a global economist and chairman of Starfort Holdings, and I spoke to him from London. Ken Courtis, welcome there.
Thank you, Tikki. It's a pleasure to be with you.
Now, look, just on Greece first, Syriza's latest offer to meet the EU and IMF almost halfway seems to be falling on deaf ears.
Yeah, I think that there's tremendous pressure coming out of Washington on the European Union to come to a deal, because they're afraid that if Greece exits, and this is a catastrophe as it would be, that then you have all of North Africa and the Middle East in flames. You have Russia making a play for Turkey and Greece, so the whole southern flank of NATO would fall away. So I think the U.S. is now putting huge pressure on the Germans and the French, in particular, to force them or to encourage them to come to a deal with the Greeks. Everyone knows that this deal will not be the final deal, that Greece needs a third bailout, but they need some more time to get there, and they need 2 weeks, because in 2 weeks from now, if they don't have a deal, then the whole thing does collapse.
Is it possible that Greece is going to make a play to move towards Russia, as people fear?
Well, Russia doesn't have the type of money that Greece really needs for a bailout. So what would happen if they can't come to a deal in Europe? Greece would default. It would not pay back much of the debt that it owes to the rest of Europe. Debt, by the way, that it accumulated to bail out the European banks.
Yes.
And then Russia would make a play for energy and for port access. And if you take what's going on in Turkey, where Turkey seems to be moving away from NATO into a closer relationship with Russia, with the fire in the Middle East and North Africa, we could be in for a very serious trouble if that happened from a geopolitical perspective. So I think at the end the Europeans will come to a deal with the Greeks, and fingers crossed that it happens sooner rather than later.
Now, looking at perhaps the bigger trends at the moment, global debt around the world seems to be at quite high levels.
Tikki, this is the great irony. We've been, since the U.S. bubble popped in 2007, 2008, in a period, we're told, of delevering when debt is being reduced. But in reality, virtually everywhere in the world, debt is higher. Indeed, total debt in the world today is 55% higher than it was in 2007. And virtually no country today has any fiscal margin of maneuver, with no country, very few countries have any capacity today to spend more money. So if we do get into a new crisis, it's going to be not very easy to manage it, with all of this debt hanging down there.
Well, I was going to say there is this great expectation that at some point this year, the US is going to raise rates. What is that likely to do?
Well, I think, Tikki, the key numbers that we have to watch for the U.S. now are what happens in the second quarter. We had this miserable first quarter of minus 0.7%, and if you netted out the increase in inventories, that is, goods and services that companies accumulated that they didn't sell, if companies think that the economy is slowing, they're going to take down those inventories, and so growth could end up being very weak in the second quarter. I'm looking for growth between 1% and 1.5%. The consensus is way up at 3%. So if we get below 2%, I don't think the U.S. will be increasing interest rates.
So what are the implications then for the stock market in the U.S.? Because there's a lot of expectation about corporate profits going forward, isn't there?
Well, if interest rates do go up, and that's, I guess, the mainline forecast, I'm pretty much outside the consensus, then we have, I think, a problem, because profits at the moment are flat. They will then become flatter over time, because people will expect that interest rates don't go up just one time, but they go up 50, 60, 75, 100 basis points, 1.5 points. And that then would put a very expensive stock market into trouble. And it would particularly, I think, Tikki, be destabilizing for many of the emerging markets around the world, which are tied to the dollar. The dollar would get stronger. It's going to be complicated if they raise interest rates, to say the least.
The other very important asset, of course, is bonds. We've seen this massive sell-off of government bond markets over the past couple of months. Where do you see that headed?
Well, bonds are still, if you look at the long-term trend that starts way back in 1980, so almost a third of a century ago, bond prices, therefore interest rate yields, have been coming down. If the U.S. starts raising rates, that trend will be over, and we've got a long way back to go on the upside of interest rates if that were to happen.
So, Ken, just looking at currencies now, I've noticed right now we've got this falling yen. There is talk now of a major currency war within Asia. What are the ramifications there?
Well, the yen is down, if you think of it, Tiki, 66% against the dollar from its peak in 2012, and 69% against the Chinese currency. If there's a currency war, Japan is the big aggressor in that war. And if the U.S. raises interest rates, obviously the dollar is going to get stronger. The yen has just broken a 25-year trend line on the downside. And I see over the next couple of years, despite what the governor of the Central Bank of Japan has been saying today, where he's been saying the yen is weak enough, I see the yen going to 150, 160 over the next 2 or 3 years. And that will force the Koreans to devalue. And the real question is, can the Chinese hold their discipline and their currency at this level as Japan continues these beggar thy neighbor policies by devaluing its currency?
And commodities markets, oil in particular?
I don't think oil has bottomed yet, Tiki. The supply side continues to be very strong. Demand is weak. We've had a pop in oil prices in the last few months, essentially because financial investors, ETFs, hedge funds have come into the market. But the underlying dynamics for energy are still, I think, negative. And I wouldn't be surprised to see us test on the downside again for oil down to into the mid-40s.
Ken Courtis, thank you very much for coming in early for us there.
Pleasure. Thank you.